All right, here we go. Let's get fired up for Deal Deep Dive Day.
Wait a minute. Oh, that's a generation. Yes.
Line, mute, admit. Grab the glass of water. And here we go. All right, we already have a bunch of hands up, so we'll go relatively quickly. For those who are new, Deal Deep Dive Day, share your deals. Tell us about the deal first before just throwing a spreadsheet right at us. But other than that, this is about preparing your deal no matter what state it is in. If you need help with the calculator, awesome. If you need help with just putting together the structure, the deal, the debt, or the equity, we'll go ahead and get rocking. We do have a bunch of hands up, so I will get going rather rapidly here. Mark, I see your hand up first. We'll go down the line from there.
Yes. All right. Hello, Christian. Thank you for the help. So just
Absolutely.
got same Fresno deal.
Yep.
Just got a delinquency report yesterday that my son Drew poured through for us. So they're selling it at 36 occupied. Original OM was 37.
Okay.
Going through the delinquency report, it's 33 economic. So
Okay.
that's a combination of multiple Section 8 tenants not paying their part, but the county's covering. So
Okay.
what do you do when you spring that on them? Is it all upfront in the price? Is that a last minute, well, we found these inspection items and your books issue?
Yeah, so as you go through the due diligence process, I would just look at it like, okay, so here's what was advertised as what it was making. Here's what the books are saying it's actually making. So
Got it.
we just simply make a determination from there.
So it's temporary, and I already know the property management's awful, so we're replacing them, and I do expect occupancy to go down before it goes up. But when do you leverage that? Do you trade it for maybe a delay in getting the loan because you're still doing a raise, or what's the best way to play that information if we don't change the price up front?
If you don't change the price up front, I typically my normal phase, I want to collect all the data I can. If we're within the realm of where it's like, okay, we could still probably close around the numbers that we're finding right now. I'm like, okay, that's good to know. I want to gather as much information I can so that we ask all, if we have a ask to adjust anything, it takes into account everything. So the time to do that is usually shortly before waiving feasibility. If it looks like the deal's still probably a go, then we'll go, okay, let's get our inspection done, let's get our pieces together, and then let's ask for what we need. If they decline, then we just run one more run of feasibility. We go like, okay, does the deal work where it's at? Or do we need to cancel the contract? Those are the two options. And canceling the contract is always okay if the deal no longer works after you've done due diligence.
Okay. Well, it's still, I see it as temporary, but I don't want to break any foundational rules. We're going to
Yeah.
be disrupting anyway as we get the folks that aren't paying out. That's the plan.
Hmm.
Just a bit more than we expected. So that moves the break even down the road 3 or 4 months is all I see it as.
So when we're looking at the economic occupancy of an additional few more, is that saying just overall in proportion to the rents, or are the delinquent people still partially like? Do you have just a few people who aren't paying their Section 8, or do you have a bunch of people aren't paying it, which is making up your overall economic occupancy?
Great question. So we have one that's a regular, not Section 8. He's just going out. 4 months delinquent. Sorry, goodbye. So that's the cash for keys question from yesterday. The other uh, two economic units are a combination of their portion of Section 8, rubs, other minor fees that the place charges. So it's equivalently 3 units total that is scheduled rent they're advertising on that's not there.
Yes. Okay, that makes sense to me then. Yeah. At the end of the day, you're going to run your numbers and your feasibility, and if there's something there, usually if they're notably different, which they are, there's usually an ask, but you should know going into that ask if it's like, okay, if they say no, are we still moving forward?
Okay.
Much smaller example, but I had a duplex that was supposed to come with laundry machines. It's in the contract. they took out the washers and dryers. And they're like, oh, those were owned by the tenants. I'm like, well, you shouldn't have checked the box on the PSA. The broker's argument was, well, it wasn't listed on the listing. I'm like, I don't care. You checked the box on the purchase and sale agreement. I need a credit for these. And they said no. And I'm like, okay, this is frustrating because I'm right. But the deal didn't work because of the washers and dryers. So if you have one of those situations, it's okay to ask. And if they say no, move forward. Just know if you're going to move forward or if it needs to be adjusted, is basically at the end of the day what the numbers are going to tell you.
So I guess the scarier question, that's June numbers, books are closed. July 7th hadn't paid as of this July 11th delinquency report. One caught up as of last night's delinquency report. So
Okay,
is
that's
it
good to know
still
too. You
half a
might have
month
some
to
tenants who are just
go?
paying late in the month too, then. So delinquency might not actually be your full picture of delinquency.
Well, June's closed, so I would still want to call those three economic not there because there's no way to pay June rent in June anymore. So
Correct.
I don't mind the late payers because late fees are extra income. But
Mm.
7, is that high out of 39, well, 36 occupied, 39 units?
It is, but it also seems in line with the fact that the property manager is having other issues. So I think
Okay.
they all sound like things that happen under a property manager who's not doing their job. Are they at least doing a good job of collecting the late fees?
We don't have any bank statements yet. We
Okay.
just see it on their what they've shared so far. So not till I see it on the bank statement, I don't believe any of it yet.
Okay. And I would be willing to bet, based on what I'm hearing here, that they're probably doing a poor job of charging the late fees, which is why everyone's paying late or not at all. That
Okay.
is my educated guess. We will see if I'm
Yeah,
correct with the bank statements.
you're probably right. And then planning to do multiple deals as soon as we can.
Hmm.
Does signing on a commercial loan for one hurt for the next one like it would on single family acquisitions, or it doesn't matter on
Not
commercial?
as much. It's taken into account that you have other active transactions and other credit pulls. But in commercial, it's commercial, right? It's a job. Lots of people buy multiple transactions at the same time. That's like a normal thing to do. As opposed to like, hey, I'm buying a single family house while closing on another single family. So it will come up, but it's not really going to particularly hurt you.
Okay. All right. And then Drew, my son, found a couple in the Bay Area where they're still hugging tenants with 40% economic because the courts are behind and they gave extension if you could claim it all. COVID was a reason why you can't pay your rent. All this later, I think we chatted about that
Hmm.
briefly. Is that just too low, so unstable, such a bridge loan that you shouldn't chase anything like that?
I I typically wouldn't unless you had a deal where you had a really, really clear, concise exit from that product.
Okay.
So if it's, I don't like unstable, especially when I'm in the build phase, like the prime build phase of the portfolio. When you have a
Okay.
stabilized and optimized portfolio, you can take a little bit more risks if you can cover it in cash or you can, if you have more pieces. But as you're like, hey, we're getting to the first few larger multifamily deals, I would try to minimize the variable or short-term things in my deck of cards.
Okay. I appreciate that. And that's it for now. Thank you very
Okay, that
much.
sounds like a plan. Ricardo.
Hey, Christian.
Ooh,
You mind if I switch computers real quick, Christian?
absolutely.
Sorry about that.
No problem.
All right, I'm on this computer. Sorry, I have everything about the deal on this one,
Nope, you're
and I
good.
have them both like open. So yeah, I don't know if you recall, a couple weeks ago I showed you a deal where we had, day one cash flow, and I'm ready to place an offer on it.
Excellent.
Uh, and two things that have come up. First off, like I could probably do this on my own, but like if I could find a partner to come up with a down payment, I think that would be like much more attractive to me. That's
Hmm.
one of the things that I wanted to talk about. And then the agent was asking if I want to go through him or act as what was the word? Unrepresented buyer. So I didn't really know like if there are advantages to doing it that way, if like it's just less 3% to him and more money in my pocket. So like I wanted to get your opinion.
So he's wanting to charge you to represent you as the buyer.
No, he just gave me that option. Do you want to act as an unrepresented buyer? And like I don't know what that entails really. Like,
Okay. So traditionally in almost every transaction, the seller is going to be the one paying the fees. So the broker will get paid the same either way.
got it.
I wouldn't want to go into a transaction as an unrepresented buyer. I want to have a broker responsible for all the paperwork there. So in different states, dual representation, most states, dual representation is allowed. Some it's not allowed, but most states they can represent both sides. And so I actually love having the other broker represent me, while their interest is first and foremost their original client. So, you know that going in. I have found that some of my best deal flow has been from just having, like, if I don't have another broker who I want to represent me, having them come in and it's like, okay, cool. I like the deals that you have. We build a relationship. They usually bring me multiple deals. That's how I met. I think I brought this up on Monday's call briefly, but that's how I met Eric, a broker I've done 5 transactions with. He cold called me on a 10-unit deal. He represented the seller. I had him represent me, and then my next 4 transactions he found and I closed. It's a great way to build a relationship, help to get the
Nice.
broker paid. But yeah, I would never represent yourself,
Okay.
just because of the liability, and also just that I don't want to spend the time drafting the paperwork. It's always nice to be represented.
That makes sense. Yeah, so that leads to the second question. Like, what are my options in terms of like finding partners for this deal?
Refresh my memory on what the deal looks like overall, as far as day one cash flow as opposed to where it's going.
So we analyzed this together,
Mm-hmm.
and I can share my screen too.
Yeah, yeah, that'd be
That's
awesome.
helpful.
Let's take a look.
Uh, sure. All right. Are you able to
Yeah.
see?
Yes. So this is our starting point.
Yeah. So if it helps to see like a picture, this is like the box building.
Mm-hmm.
You probably recall that.
Yes,
But
I do.
the spreadsheet numbers look like this. Day one around $500. And I remember we were kind of conservative here on all these expenses. Um, is there anything else that you want me to refresh your mind on? And
Nope,
then,
this
yeah,
makes
sorry, one of the things that you mentioned that I should put an offer at 205, and I sent an email today that that's what I wanted to do, EMD of $500.
mhm.
But that's the only difference between what I offered and what's on the spreadsheet.
Oh, awesome. Yeah, put that in there just so I can see the day one number at 205.
Okay. So that would be 204 900. Yeah, so that bumps up the cash flow a little bit.
It does. It does. Like, actually quite a bit because it's very, it's not a whole lot of money down. So that becomes a fairly stellar deal as far as cash on cash return. My encouragement on this, if you can't take this out yourself, this is one I really like taking out yourself. It's a high cash flow deal. There's, if I remember correctly, there's a little bit of rental upside on it, so you can push these numbers even higher. This
Yeah.
deal, if you can't take it out yourself, and this is generally my rule of thumb, if I have the money, I'll buy it without partners. It's clean, it's simple. I get all the rewards of having a great deal, and I share none of the decision making, none of the tax benefits. It's all mine. That's a clean and easy way to do it. If
Sure.
you wanted to bring in additional capital, what would you be looking for in capital? Would you be looking for uh, borrowing the down payment? Would you be looking at splitting it and going like 50-50 with someone as a partner? What would your goal be in bringing capital into this deal?
I'm not 100% sure. Like, if like I would be happy to give up profits for like however long, as long as like I don't have to put the capital down because I'm trying to use the capital for something else that I would have potentially larger return. So that's like my main goal is not to put that, like 40,000 down. So I'd be down to that or the other option, which I don't really have it clear in my mind what that would look like.
Okay. So I'll challenge this with one thing that I would say if I was your investor in this. So if you were pitching me on this,
Yeah.
17% cash on cash return is a lot of cash flow on a compared to a lot of apartments, right? $40,000 is a relatively small investment. Not that
Mhm.
that's no money, but
Right.
for illustration for what a lot of apartments take to put down.
Yeah.
So 17% cash on cash return. If I'm your investor and I ask, okay, so why aren't you putting your own money into this? What would your answer be?
Sorry, repeat that.
If I was an investor and I was asking you, okay, I love this deal. This is a cool deal. The returns are obviously there. Why
Yeah,
aren't
yeah.
you putting your money into this deal?
Yeah, and I would say exactly the same thing I told you. I can be like completely transparent. I have like one mortgage that if I were to pay that down, it would be basically like a higher cash flow for me at this moment. So that's kind of like the trade-off that I'm trying to prevent from like putting some of that cash on this deal.
Okay,
Um,
so you're paying down a mortgage. So basically, it's while I have the liquidity for this, I have another project that's going to require my capital. So the capital
exactly.
that I have available is insufficient for me to close this deal. So I'm looking to buy time. That makes sense, and that's how I.
Yeah,
So
yeah,
okay,
because
that makes
I
sense.
wouldn't have enough cash to do both at this moment.
You're paying down other obligations. That makes
Exactly.
sense.
Yeah.
The what I wanted to make sure is that you're not like, oh, well, I'm just saving it until I get a better deal because as your investor, I'm like, well,
Oh
hey,
no,
cool,
no.
I'll wait for that deal. That's what I want to make sure we
Yeah,
cover.
yeah.
But that actually does make sense. I have other obligations that I'm paying down. While I could close this myself, I don't think it's responsible to do this. I would like to do this with a partner and that has the returns to do so. Um,
Yeah.
my instinct on this, if these are your day one numbers and they prove out to be correct, I would look at doing this as debt because I can borrow at 12% interest and I still get paid 5% interest on this. And then with debt, you pay them the principal. There's no multiple. So you can service debt on this where you can give them cash flow and pay this at a later date out of a cash out refi, out of saved cash flow, out of earned income. It's a low enough dollar amount where I think I like this better as debt than have, coming in with an equity partner. And that's how I'd raise this is I'd probably
Right.
do it at private capital rates, see if anyone wants to lend at 12%, which is a fantastic return on a deal that's cash flowing day one. That should be a pretty easy capital raise for $40,000. That should be a pretty easy capital raise.
Okay. Yeah, now that you mentioned that, I do think I have like a HELOC laying around somewhere where I could probably, get like a better rate. I think it may be like 7%.
If
So,
you had a HELOC at 7%, I would 100% use that as your debt product for this. That is
okay.
the right use of a debt product. Borrow at 7 to make 17%.
Yeah,
That's a good deal. That's just a straight up good deal.
cool. Okay, I will probably go down that route then. I think I don't have any more questions at this moment. So I
Okay.
appreciate it.
If you do need to bring private capital into this, this has the right yields where I would avoid using a capital partner on this. I would use a lender to bridge the relatively small delta.
Cool.
Yeah.
Sounds good. Thanks so
Yeah,
much.
cool deal. This one should be clean and simple for you.
Yeah.
It's a kind of ugly building. It's entry level housing. The maintenance and repair are just fine. This is
Yep.
about as clean and easy as real estate should be, barring anything catastrophic happening. The deal looks just like a clean, this is a good deal with high cash flow.
Cool. All right. Yeah, so I sent the email today. We'll see what he says from the owner. But yeah, if I have any more questions, I'll reach out.
Yeah. Awesome. Awesome. Awesome.
Thanks.
Awesome. Yeah. Keep me posted. I hope they accept that. That's a really cool deal.
Will do.
Matthew.
Hey Christian,
Hey.
so I just started underwriting deals. Um, Today I brought like two, three deals to the table, just quick initial looks. I just want to make sure my math is correct. I'm doing the
Absolutely. Absolutely. When we have
understand.
multiple deals, we'll just take them one at a time and so cycle through the line there, but
All
not a
right.
problem at all. Which one are you most excited about?
Um, so the first one I'm most excited about, well, I think um the most interesting deal is a mobile home park in Houston,
Oh,
and
okay. I love
let's just
that.
look at that first thing.
Yes. I keep getting beaten on them for offers, but I keep finding mobile home parks in Texas, and then I offer on them, and then 17 other people offer on them. So they're popular, but there's some mobile home park deals that keep popping up. They're awesome to own. They're very easy to make money on.
Wait, so a quick question on mobile home parks. Based because of that mobile home park deal that I saw in Houston, I started looking around, just randomly at mobile home parks, and I found that they are just you can't really find them in a hyper local way. Like they're just scattered all around Texas or even in any state.
Yeah,
So
it's mobile
how
home
would
parks are a
you
little bit
like go?
interesting. Sorry, I keep cutting you out.
No,
Uh,
it's fine, it's fine.
so it will be a little bit. It's similar but slightly different. Mobile home parks, a lot of the home park owners end up owning a ton of parks over a larger radius. So when you meet like the owner meeting, the hyper local, like, hey, I want to be the mobile home park guy of Stephenville, Texas. It's like awesome. So I have 3 parks I could ever buy, right? It's there's not that much. But what happens is the guys who own mobile home parks in Stephenville own them in Mineral Wells, own them in I'm blanking on the town, one town south. But for illustration, they own them in a larger radius, and they all kind of operate with their own on-site managers, how they usually work. My friend Jan, well, he actually just legally changed his name to John because he's tired of being called Jan, but it's spelled Jan. My very good friend Jan, or formerly known as Jan, he has about 700. He might be over 1,000 mobile home park units now. He owns in Washington, Ohio, Florida, Texas, Tennessee, that I'm aware of. He was looking at a deal in California. I convinced him not to do it. I was like, if you're going to be everywhere, you can skip California. You don't live in California. He picks
At
up,
least
he
be
just
able
has a
to
huge
own.
radius because he got good at installing managers. You do have a more decentralized model, but they do tend to cash flow quite a bit. So the investor who you bought from here likely has other parks. You just have a larger radius for your business if you do mobile home parks, is generally what it looks like. That's the difference.
But would you say like because it's more decentralized and in a way it's a little bit more hands off, you could the radius in which you can buy um parks and still manage them well is like larger. So you don't have to buy all of them in the same place and still be able to work it.
Correct. You want to typically you want to buy a park that's large enough to install an on-site person. You can do a lot with software because at the end of the day, the goal for mobile home parks, and this is for everyone, the ultimate goal is always to get the mobile home parks to be 100% tenant owned if they're not already. You want it to be passive. You don't want any of the maintenance. And with all the maintenance off you, you need to install a good park manager and you have to have a good bookkeeping system outside of that. And you can have a huge radius. You don't have the contractor teams and the massive on-site presence and the a lot of this stuff that you do on a local business. You don't need a lot of those pieces to run a mobile home park if you don't own the mobiles yourself.
Would you just one last question before I dive into this deal? Would you
Yeah,
recommend me starting off my first deal with the mobile home park?
absolutely.
Would
Absolutely.
all right.
They're just there's slight differences. There's little things that you should know about them as you go through it. But overall, mobile home parks are no more difficult or easy than a single family. They may be a little bit easier. Um, my I have an RV park. It does have a mobile on it. I also have mobile homes that we rent at the Robin Hood. So I have a very small mobile home park, and then I have an RV park. They're the most passive real estate that I own. I have an on-site person for both of them. Very, very, very easy to run.
Oh, really? Even RV parks? I thought RV parks because the tenants aren't there long term. It's just like they just come in for like a couple days and come
You
out,
can
and you can't really.
you can do either model. Mine is 100% annual leases.
I see. So if the RV park is long term leases, you would only buy the RV part if it's long-term leases,
I would only
would you
buy it,
say?
but I have friends who run a blend of short term and long term, and they tend to do very well. It's just a little bit more active business. There's a business side to it that involves a little bit more marketing. Your website has to be good. You can run them, and I can show you how to run them, and I can connect you with people who are amazing at running them. But ultimately, you post it on sites like Airbnb. You'll probably use a software called HipCamp or similar software to run them. You can do short term. I would look for all long term. That's where you get the real passive thing where it's easy to expand. Annual leases, RV parks, mobile home parks, they work functionally the same. As long as they're the
All
long
right,
term leases. RV parks, if you do short term, is a little extra work.
all right, you got it.
Okay, so they
Thank
got an
you.
unpriced deal here.
Just a 51 pad mobile home park, just just outside of, actually basically inside the city of Houston. And it's 85% occupied. Um, so let me pull up the offer memorandum. So current, so this is the rough numbers I had. Um, I put on purchase price, I put 3,000,001 because I saw some other mobile home park in Texas that it's about the same size and it's sold at like 3,000,005. So it was a slightly larger mobile home park, so I just dropped the price a little bit.
Yep.
And because when I was looking through the offer memorandum, the the rent for the mobile home, each mobile home was just different. It was not uniform. The way I got the rent is I just took the effective income and then divide by 12. That's how I got this number.
Okay. For this calculator, that'll work as a first take.
And then for the annual property taxes and insurance taxes, because hold on, I just wait a minute. I believe I hold on. I took the way I calculated it was because I calculated the rental income. Wait, hold up. Sorry, I did this part wrong. So this would be the new annual property taxes based on this value, based on the purchase price. Let me
This is why
redo
it'll
it.
be important. So this is why it's going to be important with the mobile home park. Do we know if these are park owned or tenant owned?
I believe it's park owned.
Okay. Property taxes on these usually aren't too high. Insurance is a lot higher if you're insuring all of the homes individually.
I see. Yeah, it's park owned. So what you would do in this case after say you buy the property would be to try to transition everything into tenant owned homes. So like you would try to seller finance each of the lots to the
Mm-hmm.
renters.
Yeah, so there's only two tenant home mobiles. Got it. Got it. Got it. Got it. Got it. Okay. The RVs seem to all be short term. I'm just judging that by the fact that they have a 25% vacancy factor. Your cell tower income is freaking awesome. That is an awesome bonus that you have a cell tower in the middle of it.
Oh yeah. So the deal said that currently the the seller is still, I believe, paying a payment on the cell tower because he just installed it like a year or two ago. So, but when by the time the new owner comes in, you would be making like just north of 1K a month through the cell tower.
That's a really cool bonus. I do actually like that. Okay.
And then
I
what would you say for the insurance though?
What are they currently paying for taxes and insurance? That's going to be an easier basis for this because it's not going to be calculated the same as buying an apartment building for those. Insurance expense, they're
So
doing 4,500, property tax 51. Okay, I think 65 is fine then. That's probably a good estimate. Their insurance, I think seven's fine for right now. I don't know all the detail. It's going to be You're going to need a professional quote. Maybe put 10 in there for right now. You're going to
now
need a
for
full quote for
property
what it's
taxes,
actually going to be.
do you usually double it or you calculate it based on like I believe 1.95 or 1.85% of the
Yeah, I
purchase
do about
price?
1.8% of the purchase price is about where I'd fall out on that. And then usually they don't like just absolutely blow it up from where it's at right now. It's at 51 right now, so if it moved to 57, that's in line with what I would expect. So I think you're fine with that estimation. Insurance is the one I have the big question mark on. I'd want to get a rough quote for what you would look like on these. But for right now, they're paying like 5,000. That was per year, right? For what they had on their chart.
Yeah, that was per year.
Okay. We will hold that there. Their repairs, so we're going to use their numbers for where we can. So they have 25K in repairs and maintenance. So we're going to assume that that's the cost.
And you just that's the annual cost, right?
Yes, it is. So divide by 2,000 ish a month. Just call it 2,000. That's easy. So basically, what you're going to do when you have actual numbers is you're going to basically copy over what they have for the places that you don't already know. And so I don't think you're going to have a lot in office supplies or all these other things. Like some of these you won't have. Some of them
Wait,
you will.
what do you mean you won't have? Like it's not on the spreadsheet
So they do
or
15,000 a year for management. I'm imagining that's probably about right. Repairs and maintenance, we're gonna copy. Property tax we have. Surveillance, I'm assuming they have cameras on site if you're gonna keep that going. Depending on how you're running the RV spots, you may or may not need advertising, but you probably shouldn't need a lot. Your property manager should be doing most of that. I think those are the main things. I would just add in, there's a few miscellaneous charges here that they have that may come up, but I don't think you're gonna have 2,000 a year in office supplies. I doubt. I don't think you're gonna
okay.
have. Oh, that's the main one. Okay, go back to the calculator. I'm not seeing anything for landscaping, which I'm curious about. Because it did look like there were some grass areas. Tenants may be responsible for that. Let's leave it. There's a lot of
All right,
grass. I'm guessing there's common
what do you think of
spaces. Let's assume there's at least 250 a month for landscaping, and we can adjust that if we get more clarity. I assume someone's cutting the grass. We use their
management?
actuals, so you can skip vacancy for right now because you're using their actual collected. So we'll go off that for now. We can adjust as we get more data, right? We're just going off an operating memorandum. It doesn't have to be perfect. Now, if
Okay.
just from instinct, you usually want a higher cap rate. You expect higher returns on mobile home parks. 3.1 for that many units is relatively expensive, but you do have a lot of park owned things. Let's look at the analysis first for the day one analysis. There it goes. So we're sitting a
Believe it.
little under break even right here. And for me to get really excited about a mobile home park in Houston that's unpriced, I'm going to be offering a lower offer. Anyway, so this is fine. There's a mobile home park that's totally different area of Texas. It's out in West Texas, near Lubbock area, which is a less expensive spot than Houston by quite a bit. But there is a mobile home park that was, I believe it was 30 something units that just sold for 400,000. Their rents weren't way underneath this though. So there's some variability in these. This looks like it's in pretty good condition. I would need to do a little bit of research for what we usually would see as a market cap rate for mobile home parks. I'm going to, if anyone knows, you guys can challenge me on this. I'm going to guess the market cap rate is about a 10 cap for market cap for what we'd expect for a
About
mobile
a
home
10
park.
cap.
They're higher than multifamily is what they trade on. I could be a 9, it could be better. Let's go conservative. If we go to day one analysis now, it should at least spit out a rough valuation, which was closer to 1.5 million, which is about what I was thinking for 51 units. That's probably closer to where I would want to offer for this.
So let me see how it works on 1.5.
Unbelievably well. So they're going to want more than that. That's about what it's worth on a 10 cap.
You didn't move your down payment, so just
Oh, there we
write it
go.
in first.
I did. Wait, was it already 300,000? No, was that the? Yeah, the down payment's correct.
Oh, yeah, you're right. Yeah, that's 20%. 8,000. Okay. Well, they're probably, I'm going to guess if I'm them and that's their income. That's probably not what they're going to want to sell for, but it's good to know around where we're going to peg out for value in that market. I have, what was the average rent there? I'm just kind of basing it off a few things. I just did a mobile home park valuation in Washington. My 25 units that rent less than this, but I don't have the mobiles park owned.
I said the average is around 900. Just look based off the financial chart.
Yeah. It's an unpriced deal. That's probably where I'm doing an initial offer if they're not going to give me a price. The first thing I would do here is I'd call the broker. They're probably going to be selling this somewhere around $2 million, is my guess. But I'm never going to come in at where I think it's going to sell on an unpriced deal. That is where you lowball them for two reasons. One, I want to punish them for listing it without a price. That is not an activity that I reward. Two, if they're making me throw the first number, of course it's going to be lower than what I want to buy it for. If they're listing it, they're dropping the anchor. If I'm dropping the anchor on the negotiation, I'm going to drop lower. That's tremendous cash flow on a mobile home park. That's a really good starting point. And you never know. It's been on market for a second, so they may accept it. It hasn't been on forever, but it's been listed for a minute. So the first thing I would do on this, you have a few steps. I think we got at least a basis of what our math is gonna be. You want to do a little bit more research into the uh, cap rate for mobile home parks in that market. You can call basically any broker who lists similar parks. I wouldn't call the one who's trying to sell it to you. I'd call someone else and I'd do the whole broker script. Hey, I'm looking at your park. I'm also looking at a couple other parks. Would you be able to help me with what you're seeing for market cap rate here? I've been using a 10 cap. Is that accurate? Just get a broker's opinion. The next step is calling this broker and trying to get them to give you a ballpark for where the price is. I wouldn't just submit an offer for 1.5 million. I would call the broker and say, hey, I've been looking at this based on what I've seen for a couple other deals that people bought off market in the area. I have a price in mind, but I have no idea if it's going to work at all for what they want. Do we have a ballpark for where they're looking for an offer on this? And hopefully the broker will tell you. If they say no, we're just looking for what offers will be submitted. Awesome. Very interested in 1.5 million, and I'll bet you that's where most people are going to come in and offer on this.
Sure.
And on a listed RV park, they usually get a lot of lowball offers anyway. you just kind of keep working the equation and see what you get. For a listed property, it's not like every single RV park I underwrite is something that I go under contract for. So don't try to force it. Just ask for where you know it works. It works very well to 1,500,000.
All right. Thank you, Christian. One more
Perfect.
question.
Yes.
For RV parks, do you think the state of just looking in, sorry, for mobile home parks, do you think just looking in the state of Texas is completely sufficient?
Oh
Do
yeah.
I have to look at any? All right.
No, there is an awful lot of Texas. There's an awful lot of Texas. Plenty of great RV parks out here. I know Jan or John now has bought he bought a bunch out in there's one in I think it's called Beesville. It's out near Corpus Christi. It's on the coast.
Right, got it.
He's done really well in mobile home parks out there. I've seen a bunch of them south around my properties in McAllen and Laredo, Texas. So not that far, but well, Laredo is, but McAllen's quite close to Houston. I've seen plenty down there. There's no lack of great mobile home parks or RV parks. They're just a little bit more spread out.
All right, got it. Thank you, Christian.
Absolutely. Steven.
Good afternoon, good evening, good morning, wherever you happen to may be.
Haha, I am home in Texas. I will be at some point. I'll be in back in the Bahamas, but that will be
Oh,
it's only an
sweet.
hour ahead, right? They're Eastern time. Is that
Yeah,
right?
they're Eastern time. Fishing?
Basically the same.
Fishing or
No,
vacation?
not working. When this 76 is taking so darn long to close, I'm scheduling an October vacation for Christian too. I will
Good.
still be hosting the mentorship, but I'll be hosting the mentorship from an island.
Nice, nice. Hey, so real quick, I finally was able to get a hold of that broker
Mhm.
that had that one property for listed for 3 years and 3 months.
Oh, okay.
Yeah, and this is kind of what it looks like. I don't know if you guys can see this or not. Can you see the building?
Yes.
So so it's basically five duplexes, one quad, one 5 unit, one 6 unit, one 8 unit, and one 9 unit. They've remodeled some of them, and this is what their updated units look like. Basically, they just threw in some LVP on the floor and gave it some paint. It still looks like really old cabinetry, which this is typically a starter for, entry level housing.
Mm-hmm.
But I'm looking at these pictures and they don't look too bad. The roofs look new. Looks like they got brand new gutters on them.
Mm-hmm.
They got paved parking. Here's one of the other buildings, a 2-story, and a bunch of duplexes. So with that, let's see here. This is they're asking for 2.9 for this thing. And right now it's at 25% vacancy. It's
Ooh,
got
okay.
it's got 22 one-bedrooms, two of them are vacant, and it's got 18 two-bedrooms, 18 or 8 are vacant. The FMR for the one-bedrooms is 883. The two-bedrooms is just under $1,100. He probably let this one slip, but he said one of the duplexes was gutted by a fire, but they have a new roof on it. And he says they got a quote at 75K to rehab it. And so I'm anticipating the other units need to be upgraded. And he mentioned about 12K to upgrade the units. I'm figuring at 15. So I need a budget at 210. So I did the 1% rule because and what I did was, even though these rents are lower than what the actual rents are, because I averaged them for over 22 because I couldn't figure out how to do the vacancies. So I figured out, 22 units at $562 and change. It basically comes out with the same number of $20,410 for monthly rental income.
Got it.
So with that being said, you come over here to day one analysis and it's really ugly. And it's got a negative cash flow of basically 7K, 6802.
Quick question with your calculation for income. I just thought of this.
Sure.
The 20,000, is that where they're at today, or is that factoring
Yes.
for the 25% vacancy?
That's where they are today.
With the 25% vacancy?
Yes.
Good news. You also factored for 25% vacancy, so you took the vacancy off twice. If that's what they're bringing in 25% vacant, you can delete the 25% vacant because it's taking an extra 5K off the income.
Okay. So leave this at 0?
Yes. Because 25% vacancy is already factored into that income that you put there at the 20,000, right?
Gotcha.
So that should
Oh,
make this
that's
look
a lot better.
much better. I was like, this is too low for being a 1% rule. Something is off.
Okay.
That's what it is. Is we already factored for 25%, and then we took 25% of the income after 25% was already taken off.
Gotcha. Okay, that helps this project a whole lot.
Okay, we're close to break even. We have a
So,
lot of lease up for this.
well,
I
and
am
that
good if this is personally for this much upside. I am good if this thing is at like 0.01% cash flow. Like as long as it's not losing money and we're really close. We're really close.
well, like I said, well, now this is $1,700 negative, but then I'm figuring it's between a 6 month to 9 month project to stabilize, and then when you get it, we're cash
Mm.
flowing at 89, at almost $9,000, 24%.
Yeah, that looks really strong.
So would
Stabilized
you?
cap rate at 11. It's worth $3.5 million. I mean, this is kind. This looks fairly similar to the 38 plex that I did. Like that first deal, the first time we ever made $1 million. I am always hunting for the other one of the 38. I bought it for $2 million. I got it to being worth almost four. This one doesn't get quite that much, but you have a seven-figure win sitting in this thing. I do like it. Um, I do like it a lot.
When you say seven-figure win, you mean in the cash out, max cash out? Yeah,
Oh, I'm just looking at the total equity built, right? If you're buying a
gotcha.
2.1, granted, well, you're putting some money into it, right? So you're making about $1 million in the deal to be distributed between you and partners. You have about $1 million from where you bought it for what it's going to be worth, which is a strong position to be when you're only buying for $2 million. You're looking at 50% upside. That's a lot of upside.
Okay.
So
So you wouldn't run away from this because of the day one analysis at being in the holding cost that much money.
I want to see I really want to see 4% more in the cash flow. How do we push that cash flow by 4%? Is it getting an interest only product for the first 2 years? That likely gets us there.
Well, if I go interest only, then it gets me to right there. It
Oh,
gets,
that's a cool feature. I like the IO checkbox.
I'll send it to you if you want.
Show me how to make that. I want to add that, but I don't know how to do it.
Chat GPT.
Oh, well, I'll be chatting with the GPT. Everyone, Calculator 5.0 of this year is about to come out. That is what I need.
So with this, with the interest only, that's a extra $1,500 savings. So yeah, that would be even more. Would a bank loan on this with the DSCR being at 0.98?
They would probably take into account the upside on it. They're probably going to want more down than 20%.
Okay. What do you think? 25%?
They're
30?
probably going to want 30% down. There are exceptions, but that's my guess.
That's still not bad.
No, and you put enough down where you get back into positive cash flow because you have a negative return on debt. So you borrow less money and your cash flow goes up.
Okay.
Um, I mean, if
So,
we're gonna offer two. I hate to be this guy, but it's like, we're gonna offer two one. Might as well just try to offer two. It's been around a while, right?
well, here's the point. That's what I'm saying. They're in no hurry to sell. I mean, they've been asking 2.9 for 3 years. So I'm thinking they're not even going to accept this at 2.1.
Okay,
So, I
you're
mean,
better than break even on this debt product for the first right in the beginning. You have a way to get this to really high cash flow. Um, Rates have been fluctuating a little bit, so hopefully 6.5 is feasible. It'll be somewhere around 6.5 to 7%.
okay.
Um, just to stress test it, what does it look like if we end up closer to 7? We're still sitting right around the break even. That's not going to be the deal breaker on this.
Okay.
On the exit analysis, what does it look like when we're holding at 7 without the IO? It's still strong cash flow. It's still strong cash flow. And what will happen is there will be a rate market where you're going to end up dropping. You'll refinance somewhere in here and drop the rate anyway.
Right.
Cash flow will be strong, more than likely. We won't math for it, but we'll just kind of know in the back of our head.
Now, would you go up on this price at all in negotiations, or would you just leave it at 2.1?
I think 2.1 is where we hit that just above break even for a deal that has a ton of upside. I think this is where I'm comfortable with it.
Okay. Now, here's my second question.
Mhm.
This is all conventional financing with the bank and stuff.
Yeah.
So they told me that there's a $600,000 dollar assumable loan at 4.5%, which is awesome. But they will only be in first position, so I couldn't assume the loan and then get financing. So I'd have to get financing from the seller. So how would you approach that? Because 7% I think is a little bit too much for interest for them, or is that a reasonable rate?
It's whatever makes the deal work. If they wanted more in price and you can assume the loan, question number one for all assumable debt, how long is left on the loan term that you're assuming?
I don't know. I asked the broker and he looked for a few minutes and it was obviously he didn't have it in front of him.
Okay. Uh, if it's if it's only 2 year debt, then it's like, oh, well, that's not very helpful at all. If they have some time on that debt, really helpful. I'd probably ask the seller to match the bank debt if we want to go up in price. So if the bank's at 4.5% interest, I can do. This is where the guess and check works really well in the calculator. Try 2.5 at 4.5% interest. My instinct is this is going to work, but let's verify. And then I'm assuming it's all going to be amortized. Yeah. Oh, wow. What are the odds? That does put us right at that break even number. That's better mental math than I was trying to do. That was a really good guesstimate. Points to Christian. Um,
I had a superintendent tell me one time it's better to be lucky than good any day of the week.
that was fortunate. I was like, this should be close. That was definitely the guess and check method. We just nailed it. There's your break even number. So you can probably offer them like if you can get the debt across the board at 4.5%, then you can probably offer up to 2.5. I'm likely coming closer to 2.45, so I have a little bit more margin.
Okay.
But again, you still have a lot of upside.
All right.
Um, and in that, you could start looking at lower down payments too, because now the seller's carrying a larger portion. So there's play with it, but I think those are more or less your goalpost. Is if you're playing conventional, 2.1 is your max price.
So, okay.
And if you're playing with the assumable note and seller financing, the higher the interest rate is, the lower the price has to be, right? So if you can get the bank at 4.5 and you can get them at 4.5, that puts you at a max of 2.5.
Gotcha. So would I use the blended rate figuring this out, or would I use the 4.5 plus 4.5 is 4.5?
That was the math I was doing. That's why I chose that number, because it was the least amount of thought required for Christian. But yes, ultimately you would use the blended rate. This is where when you get that custom, I like to just replace the number altogether on the calculator. I'll just overwrite the field. But I'm like, okay, so if I'm borrowing 600,000 at 4.5% and I'm borrowing the delta at 5.5, what is the total payment? And I'll just plug that into the analysis.
Gotcha. Okay.
But
I
at
think
least we got our margins on this for where we have options.
10-4. Okay. Thank you very much.
Absolutely. I really hope that one works. I like that deal size a lot.
Well, and the one thing that I really like about this is they're selling 2 vacant lots with it. So like you mentioned in one of the other meetings meetings that we had, want to go to refinance, see if I can have them exclude those 2 lots, and then I got 2 lots to build more units on.
That's the way to do it. Two free and clear lots are much, much, much easier to get debt on.
Okay. All right. Thank you, sir.
Absolutely. Lori,
Hi, Christian.
hello.
Okay, I'm going to go ahead and share my screen.
Perfect. Super quick. Text my wife, making sure my kiddo's okay.
All
He
right.
had his first ER visit last night. He cut his finger on we don't know what, but he cut it
Oh,
very
no.
badly, and he's managed to pull the glue off his finger. So we are keeping him bandaged and happy as can be. But I heard some crying, so I'm just making sure she's okay.
Absolutely. How old is he?
He is 9 months as of a couple days ago.
Oh,
Yeah,
congratulations.
thank you. I was hoping we'd make it through the first year without any hospital visits, but not quite. He's like his dad. There's a lot more trips ahead of him.
Well, please pause me at any point if you need to check in.
That's okay. I will let you know, but it sounds like we're good.
Okay, sounds good. So I was looking at this property, and literally while we were on this call, I got some information that it's pending, it's in escrow. So I just wanted to ask some basic questions. So when this popped up, this is in Hemet. It's an 8-unit building, and it was built in 1979. Um, when I tried to look at any of the information, I couldn't get it. So I reached out to the broker. I reached out to a friend who actually also just sent me what they were paying for rent. So according to Rentometer, average rent is between 1373 and 1611 for a 1 bedroom, 1 bath. But when I got the actual information on the rents, they were as low as 1,000 and the highest was 1,300. So on those 8, the actual rent from what my friend was able to pull is 97.25. What I did is when I looked at numbers, I was guesstimating. So I took kind of a safer estimate at 1,400 a month, and then I ran the numbers at 15 and at 16. One of my concerns is rent feels a little flat right now and almost maybe decreasing. It said they hadn't increased rent in 2 years. So looking at that, would you say like if this was something you were able to do, would you start at maybe 3% of an increase on those?
I think so. So the thing with California is you always want to make sure there's some areas that have slightly different rules on your rent increases. I'm guessing this all just defaults to your state rent controls. If you're significantly underneath market rent and you're in a rent control state, the answer is whatever the max that you can raise is what you'll set to. So for Washington State, I auto set everything to raise at 7% for the next couple years, just because that's what everyone's going to do because we just introduced rent control.
Okay.
That's generally what most Californians do as well. It is part of why rent is so expensive in every single state that has tried rent control. Is it makes rent run up faster, which is an unfortunate side effect. If you're a
Sure.
landlord and you're near market rent, rent control makes you a ton of money. It's just policy that's straight up bad for tenants. And
Sure.
they love to do it in certain states, Washington, Oregon, New York, New Jersey, California, um, across the board. It is bad, 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 bad for tenants. But yeah, if you're close, awesome. For those who are like 1,000 and rent could be up to 15, you have to factor for it. It's going to take you a longer time to get from A to B, just because of the California restrictions.
Okay, because it said the tenants had been there for a long time. It says average occupancy is 100%.
Hmm.
So as I was looking at that, they said there's 4 empty garages. So that would be potential. And they said there is a coin laundry. So I didn't see any numbers for that. So those would potentially both be additional income. I saw that the sale condition was a 1031 exchange. If this was a property I was able to actually move forward with, is that something as a first time buyer would be a concern for me?
Not at all. 1031 does give you a good indication that there won't be any creative finance on the seller's part that they'll want to do, because they'll 1031, you want to pull all the cash out at one time. That is the goal, so you can roll on to the next property. So occasionally they'll do a small bit of seller financing if they need to, but it's a good indicator that, like, okay, we're unlikely to be able to get creative here. We're going to be playing the bank game, and our only lever we can really pull is price. So that's our negotiation point. That being said,
Okay.
sometimes people do have a lot of urgency in getting these done. So it's just good to know. It's like, okay, my negotiating power is on the price, and that's what the deal is going to be for 99% of them.
Okay. And then as I was just playing with numbers, I took it at 1.2
Mhm.
with putting 500,000 in from investors. So running a loan for 700,000 at 6.5% would be 4420 a month. So then when I was looking at that 9725, I'm like, ooh, like there's not a lot of wiggle room there.
Yeah.
So when I started looking at that, then I was like, ooh, this probably wouldn't be a good deal to start with. You would want to look at something that has either more wiggle room in there or something with more units to kind of even that out. Am I kind of looking at this correctly?
Yeah, yeah. Especially with like some of these smaller 8 units, even if it's under, because they're underwriting as the average is 100%. That means no one moves out ever. That's not possible, right? Even
Okay.
if someone was just out for a month, that's 1 year where 1/8 divided by 1/12, whatever that ends up being, right? So someone's out for 1 month. You still have some occupancy. The average occupancy
Right.
isn't 100. So their underwriting is, of course, just looking at this, like, okay, it's not going to be accurate. People do in fact move places from time to time.
Sure. And then when I saw it was 153 per unit, again, I don't know if it's completely comparable, but I looked up what an average one bedroom, one house is in Hemet, and it ranged from 100 to 140. So then I know it's an apartment versus a house, but then am I looking at that as like, wow, that is a little overpriced?
Houses usually go for a little bit more per unit than apartments, usually. But there's so many factors in it. I mean, the super nice apartments will go at a premium per unit. If it's Class A and you have a full on-site gym, two restaurants downstairs, and the price per unit is usually more than a house. For something like this, I would expect that houses are probably more expensive per unit. Like a single family house would
Sure.
be more expensive than a per unit cost for a property. So if your average house price was 140, which seems low for any part of California, but if that was the case, then 150 per unit is likely pretty expensive.
Okay. Okay. So just doing quick math on this, this probably wouldn't be a good deal to go further with.
Um, I would want to see everything in the calculator, because if you could rent this at 15 and you're buying it for 1,225,000 and California's high appreciation, you should be doing a little bit better than break even. Yeah, like,
Right. That would be 1,200 or 12,000 a month and 144,000 a year.
yeah. So there I would look at, but I don't think it's enough upside to make the deal work. It's not gonna cash flow day one.
Okay.
I'm gonna guess this deal. somewhere at 1,000. You said the highest is 13. So your average rent is like 1,150 ish.
Yeah. And that's like literally it's 13, 13, 1250, 1,000, 13, 11, 1225, 1250. So definitely on that lower end. It says it's pending with 70,000 off, like below asking price.
Oh, okay. I mean, Steven brought it up a second ago, like the very quick around break even point for properties in general is going to be when your rents are 1% of the purchase price, just as a fluke in today's interest rates. That just happens to be when you're around 6.5 to 7% interest. That just happens to be the average math.
Sure.
So I mean, that would put it at, you know, we're roughly 13,800, 13,000 ish of, so like 1,000,003 is probably around your break even point. So if you come off enough below that, I'm for California, you also get away with, because you're high appreciation, you're able to offer investors a lower cash flow return because it's implied. California is hard to get into. That
Okay.
there will be more upside organically. Best guess, without having the full calculator in front of us, this deal
Yeah.
probably makes a lot of sense around 1,000,001 is where it starts being like, this is pretty good for 8 units in Hemet, California. I'd have to do a little bit deeper dive on Hemet as well, but
Okay.
like back of the napkin math, 1,000,001 is probably where this starts to get interested. They're not that far off of 1,000,001, a million two twenty
Yeah.
five. That's not an unbelievable drop from where they're asking to get that accepted.
Okay. Okay. Thank you. And sorry, literally, I got the information as my hand was raised that it was already pending, but I really appreciate your time
No,
and your
absolutely.
comments.
Yeah, this is a good, excellent drill in this market. Also, these definitely entry level housing, but these units look really clean. I like the layout of them a lot. This is it's a cool building. I think this would be a fun deal.
Okay. Thank you so much.
Absolutely. Dan,
Christian, how's it going?
very good.
Let's see. So I'm going to share my screen. And here we go. Okay, so I found a property in Greenville, South Carolina. It is
Ooh, that's a big one.
right. So the entire property is over a hair over 100 units, but what I'm
Ooh.
looking at is 21 of these units.
Oh, they're all individually parceled? Like each
Uh, I I don't fully, so they all are under this. I was asking a little bit about this yesterday. They're all under the same HOA,
Mhm.
but a good number of them are actually individually owned as condos.
Interesting. Okay. And so you're buying someone's collection of all of these?
Yeah, so I'll be
Essentially?
buying, I believe these three buildings right here, and then this one on the side. So it'd be four buildings, 21 units. And funny enough, for what you like to do, they are all Section 8 currently.
I like this. And from above, they look like they're pretty decent Section 8.
Yeah, they were built in 1983, I believe. The current owner, it's an individual. He wanted to spend a couple years renovating all of them and then sell them off as condos, like I guess the rest of the property had done. But maybe he's too ADHD like me, and it wasn't going fast enough. So he said, I'm throwing in the towel. Let's just get rid of this property. I want to cash out and go do something else. Um, so originally he had it listed for a little over two or around 98 a door. It was reduced, I want to say a month or two ago to 89 a door. It's been on the market for 250 days. And I talked to the broker a couple times, and he said on the last call, he said, if you were to come in with an offer around 80 a door, he would probably jump.
It sounds like
So,
we're offering around 75 a door. I like it.
however, in my conversations with the broker, it sounds like he's not open to anything too creative currently. He does have a mortgage on the property. And for what it's worth, it's 60% leased. at the moment. And he apparently was getting up. He came to the owner a couple weeks ago, and that was my question was, hey, why is this not selling? I asked the broker, and the broker said, that's actually what I was getting on to the owner about. So he's trying to lease it up right now with, I assume, Section 8 as well, because the 13 units that are leased are Section 8. But let's jump over here. Um, Excel. Okay. So I put in 168 for the purchase price. Let's see. Closing costs, I'm guessing 30K. I put down down payment of 400K. The thing I was really fuzzy on some of the numbers from everything he gave me, especially the one line item that had mortgage, insurance, and taxes all bundled together. I was like, I can't really do a lot with this as far as the calculator goes, but I'm going to put it in there kind of as a combined number. And this is where I'm at currently. Excuse me. So he said it was a 40% vacancy right now.
I
This
still see
is,
the picture. Are you on a different screen?
oh, you still see the picture. Apologies.
No, no problem. I think
Yes.
you might just be sharing one specific screen.
Oh gosh, how do I do this differently?
Unshare and then reshare, and when you hit share, go to entire screen instead of clicking just the screen that you want to do.
Perfect. Okay. Thank you.
Yes, I would screen share how to do it, but you can't see Zoom in Zoom. So
I use Zoom all the time. I should know this, but here we go.
that's okay.
So now can you see Excel?
It is loading. Yes.
Okay, perfect. So let's start over here on the right. These are actual market rents for the 4 different size of units that are there. Obviously, not all of them are rented, but those are the actual current market rents. The actual current rents. Market rents are $100 to $250 higher for all of them except the 3 bedroom. 3 bedrooms are at market.
Okay.
So down here, and we can start from the top. I just wanted to say that currently it is 40% occupied, or sorry, 40% vacant.
Mhm.
So that'll really change the day one analysis numbers if we could get that to even 10% vacant. So yeah, where do you want to start here? Just start at the top, I guess. I put down 168 because that was a hair above where he was asking. But I'm just a lot of these numbers, especially like I was saying, the mortgage taxes and insurance just didn't make sense to me.
Okay, so that's all of them combined for what he's paying right now, the 76.
Right, that's his mortgage, taxes, insurance, altogether.
Okay. Usually those do go up. It'd be nice to see the breakout of what's what on there, just so I know which one's which. But Greenville, I don't know what the normal multiplier is for that area for what we would anticipate for tax. That would be one of my
I can look that up
yeah.
later.
But the nice thing is taxes. You can always if you go to any house near that property on Zillow and you go to the math section and you expand the taxes, it has a multiplier there for what the average house gets multiplied on taxes. And houses are assessed with a multiplier the same as multifamily is in general. It's the only thing that I think Zillow is good for. But that should tell you roughly what the multiplier is there. ChatGPT can probably do the same thing, but if it doesn't, steal it from Zillow. Insurance, if I can see what they're paying for insurance, assume you're probably going to pay a little bit more, though sometimes it goes down. That's a good baseline to at least get your intro numbers in here. 40% vacant. The income. So did you fill in what the income should be on the other units, or are we? I want to make sure we're not doing the same thing Steven did. And we're double counting vacancy. Is this are all the incomes you put their actual income right now? Those are all the literal incomes today.
These are the literal incomes today, and I'm trusting this line to add in the vacancies.
So since that's our current rent, when it's 40% vacant, we don't need to add vacancy over it, right? Because we have 100% occupancy of the rents that we put in. right? So that one you can put at 0 because we're not factoring additional vacancy because it's already factored into our gross numbers here.
Yeah. Just put 0 here.
What I do with the vacancy factor is if you have a fully leased building and they're like it's 100% occupied, I'm like, well, we have to factor for vacancy, so I'm gonna do a 5 or
Yeah.
10% vacancy factor. You have zero vacancy. This is a good actual, right? You're already factoring for a vacancy of 40% in those numbers. So zero that one out. We'll go off the actuals for this.
Okay. I guess what I'm saying was I'm not sure I did the same thing as Steven, but these yeah, it's not, like I said, not fully up to speed there.
Yeah. If this is a good representation of about what is bringing in today, use those exact numbers because we're above average vacancy in the building right now. We don't need to have extra vacancy on top of that, right?
Okay. Yep. Yep.
That's the method I'm doing for this.
Okay. I just feel like the number here,
Unless I'm missing
forgive me
something.
if yeah, forgive me if I'm missing something, but I'm like, this number is not the full, um, I don't see where the vacancy is calculated in here.
Okay, that's what I was asking. I was saying, is this if this
Yeah.
is the numbers that they're currently getting in there?
No.
Okay, so that makes sense to me. Sorry about that.
This
I
over
didn't
here on
ask.
the
I must
right.
have not asked the question correct. So
No,
this is the
you're
pro
fine.
forma where it should be.
Yep.
In that case, use the 40%. That will be accurate.
Okay.
I see what you did.
Perfect. Good.
I asked the question incorrectly. Let's check the day
All
one
good.
analysis. So today it's doing about a -10, which isn't surprising. It has a ton of vacancy.
Mm-hmm.
Um,
We can zoom this in a bit.
my question, using our favorite guess and check method, I might make this sale just contingent on them getting the occupancy up if they think they can do it relatively quickly. What is it? What do our numbers look like if we switch it to a 10% vacancy? So if he gets 30% of these resolved,
Keeps going to 1,000. There we go.
now we're in a a good solid spot.
Right.
That might be our answer. Our answer might just be this price works contingent on getting the occupancy up to these numbers. So
And I did,
you'd set a minimum of what he's allowed to lease them at, and you would screen, I don't want to put a bunch of just like criminals in there.
right.
But
I looked up, so where is it? Over here. On the rent roll, it looks like most of these people, if you look, let's see, somewhere it says, oh yeah, lease from to like some of these people, 22, 2020, 2021, like multiple 2019, multi-year tenants, which seemed to suggest it was a stable place to live.
mm,
So that was hopeful to me. I don't know if
and
that carries any weight to you.
yeah, no, it does, and the rents are pretty decent here. This honestly, this deal looks pretty decent. What I would want to know before I even got to the exit analysis of where we could get it,
I haven't even
I
gone to
would
the
want
10
just
yet.
a little bit of clarity on those the taxes and insurance numbers. Outside of
Yep.
that, though, this is it's usually around that 8% cash flow on a relatively stable building where I'm like, this is pretty easy to come into. We have enough income where this is pretty easy to buy.
Yeah.
I'd
I
want to
guess
see the
my
upside, but I want to clarify a couple of the other things before I got too deep into the weeds on where the deal's headed.
of course, and it's good to see, DSCR could be bankable
Hmm.
when it's leased, even without raising rents, even at current rates could be bankable. So I guess my question to you is, apart from figuring out more numbers, figuring out, hey, what are the taxes, what are the insurance, all this, um, like since it doesn't sound like he's open to anything too creative at the moment, how would you approach this from an offer perspective?
Well, it hasn't sold in a while. I would
Yeah.
come to terms on the price, and I would say, I'm able to buy this, and I would play off of that DSCR. I would
Okay.
say where the bank is going to be comfortable with us doing this is going to be at about 90% occupancy. We need to get occupancy up. I am comfortable with writing an offer contingent on us getting occupancy to a bankable level, and that's what I believe my bank will want us to do. If we can come to these terms and this price works for you, then I can write this offer. If he counters and says that I don't know how I'm going to get them there, now you're looking into this is where we start to open up the lease option portion of okay, if you can't get these leased up, then why don't I get them leased up and we'll close as soon as they're leased up. That would be my two solutions for this is if you can solve the problem, I can close on it at the negotiated price. If you can hit these numbers, I can close on it. If that's not a project that you want to do or something that you think is going to be a struggle for you, I believe I can hit these. So I'll take control of the property for a nominal payment. I'll have the option to purchase at this price. Give me a year to right the ship, and then we'll close at this price at that time. And we'll just do a lease option. That's the other option here. But I would first use that DSCR as the reason the bank won't lend on it today, and give them a path of if you can help me fix the occupancy on this, about 90% is where we're comfortable with being able to close this. That should
Okay.
fly. And I do think a bank would underwrite this and say this looks great. This strong cash flow, you can service your debt, the price is reasonable. That puts you in a really good spot.
Sounds great. I appreciate that. I'm sure I will have more in a couple weeks.
Perfect. Very exciting though.
Thank you.
Yeah. Mark, then Charlie.
So great deal, Dan, which led to a new question I had as well. You would let the owner fill it, as my owner in Fresno would throw trash in there, trash
I
10
would let them fill it on pending approval of uh pending my approval. So I did this with the 26 unit. There's a couple vacancies that were causing the bankability. They when we did our walkthrough, our inspection, we found three more vacancies than they disclosed. Their price was ridiculously low, so it did not affect my offer. It did affect the bankability. I'm like, I don't care. There's a few more vacant units. Planning on filling it with my own people anyway. We need to have one more person in here for the bank to not request more down. If you guys can get another person in here, I need a minimum lease of 750 and I get to screen them and I will approve them. So it basically just says they need to hit X amount or maintain X amount of occupancy, and they cannot place any tenants without my approval. So I got to look through the underwriting. So they sent me the background check, they sent me the lease, and I approved it, and that allowed us to close without additional money. I wouldn't just say, hey, or just fill it with anyone, because that's what they'll do. They'll go, okay, we don't care about credit score, we don't care about background check. We're just going to get humans in here to close it. You're going to make sure you protect against that.
And then the alternate you were suggesting is a master lease, figure out a master lease rate that makes sense. What about taking it subject to and making the seller do temporary seller financing of the rest? So you have time to lease it up your way.
I don't like the subject to when I can avoid it, especially in commercial. They're much more likely to get called than single family.
Okay.
There's a lot more audits on my commercial debt. There's usually some sort of annual report that they ask for on most of my bank loans, where they just ask, what is vacancy? Can we see your books from last year? They want to make sure the note's still in good standing, but they're going to ask for a bunch of stuff. If a bank finds out that you sold it subject to, and you don't have all these things handy, there's just more ways for these to get audited and called. I don't want to get my commercial note called in the middle of a transaction. Especially if I don't have the cash to resolve it. That's such a just lame way to get a foreclosure early in your career. It's like, oh, I got shafted on a 21 unit building just because I got a sub 2 called. So I try to avoid those. The master lease option tends to be something that is workable at the bank because you're allowed to lease your building. That's what you're doing. You're a landlord and you're still servicing your debt. So you'd usually work the loan around where the existing income is, generally. and make sure that the landlord's still able to cover all their expenses.
All right, then back to the questions I did have. Yesterday's call, today's call, you've been talking about earnest money deposit, 500 to 1,000. I put in 1% of the purchase price, which is standard as a regular realtor here
Yep.
for regular purchase, and the brokers are saying 1 to 3% standard. Broker on the Fresno deal thought I should bump that to 3%. I said, no, I'm good at 1. Then I hear $500, $1,000.
So in California, you can just do a 1%, and
Okay.
you don't have to have money to open a transaction. In a lot of states, not all of them, but a lot of states, there's a certain amount of non-refundable earnest money that has to trade hands to open a transaction. So what I'll often do is I'll make earnest money due after feasibility. And in Washington State, I've been able to just do that. I can say, hey, nothing's leaving my account until we finish feasibility, but I'll go under contract for it.
Okay.
That's
So
fine.
1% is
In
not being,
Texas, I usually have to do $500 to $1,000 in before we can even open escrow and
I
get
see.
started.
Okay, so 1% is not being taken advantage of here by that broker because I'm new. That's California, as far as you know, at market reality.
Yeah, my earnest money for all my deals is still usually 1%. Like that's the actual
Okay.
earnest money. I just
Okay.
have a fee to open it that
I
is
see.
a hard non-refundable, and then the rest of the 1% is all a refundable normal earnest money, completely returnable to me if I back out DD.
Thank you for
That's the only difference.
clarifying. I've been
Yeah.
noodling on that for 2 days. Secondly,
No, sorry. If I
yesterday,
confused anyone else with that, I apologize. That was not the intent. Normal earnest money is going to be 1 to 2%. I'm a no-go at 3%. One thing that has helped me, and so you can share this as a story that happened to a friend because we now know each other. But
absolutely.
the I used to I had a lot of brokers who were a stickler with how much earnest money. I had one deal that had $135,000 of earnest money, which is significant. It was a 60-unit deal. They didn't show up to signing. They decided we had 3 separate contracts for 3 different buildings. The contracts don't mention each other. Rates went up. We said, hey, we're going to close on the 2 seller finance ones. We're not going to close on the conventional one unless we can lower the price because this was right like when rates were ramping. Rates went from 4.5 to 6.1
Oh,
in the
great.
time that we opened escrow and got to close. I was like, that massively changes the deal. So I said, hey, we're going to close on the other 2. We have a right to close on the other 2. They went, nope, we've decided they're all contingent on each other. I'm like, oh, well, unfortunately, you do have to put that in a contract, which we didn't sign. They just decided not to sign for all of them. And they made the claim to title, hey, we believe that we're still owed all this earnest money. They said that we had a breach of contract for a term that was never signed and never discussed. In Washington and in California, that's about 2 years to get through the court hearings for suing for specific performance. After about 25,000 in legal fees and a year and a half of them holding 135,000 of my money, thank God I didn't raise it. I ended up settling to get 100,000 back because I needed it to close another deal.
Okay.
So I lost
I'm sorry.
$55,000 over nothing. So when people are like, we really want to see more earnest money up front, I'm like, if you want more earnest money, we can discuss it. We can put it due after feasibility. I'm not going to just lock up money and put it in an escrow account. I understand the principle if it comes back, but I've had a situation where it didn't come back.
Yeah.
I don't want to do that. And brokers usually listen to that and they're like, this makes sense. I'll relay this to the seller. And so that has saved me a lot of earnest money later, but that was very very early in my career. Uh, that was pretty much the first time I ever had 135 of my own to put into a deal. And my partner Cody and I put it all into a deal. And then it got stuck forever. Horrible experience. So I'm very careful about it. 1% is usually about as high as I ever like to go.
Okay. Thank you.
Yeah,
Appreciate that. So,
absolutely.
yesterday you said the cruelest thing you could ever say to me, which was finding deals is easy. Is that just a belief system I have to get to? I am building broker relationships, so I'm
Comparative to
working
any,
on that.
I've found that finding deals easy. Okay, so I'm gonna caveat this. Finding your first deal is a massive project. Like as far as multifamily, closing that first deal in a market you haven't closed in yet for multifamily building is hard.
Okay.
Getting a
Thank you.
little bit of momentum after that is very easy. The second deal is unbelievably easier. The third deal is a lot easier. Then after that, it's all pretty simple. I'm stuck with I literally have too many deals to take down right now. They're one of them that someone should do is like a $10 million deal. I wouldn't do that as your first deal. But there's a deal in Texarkana. I'm like, it's 3 hours away in the opposite direction of my portfolio, but it's an amazing deal. The deal flow when you get a few relationships is really, really fast. Finding deals is easy. Finding your first deal is a pretty good push.
Well, you had said, maybe it was in a couple of places I heard, if you get an email from a broker, you should respond fast. So I was up till 4 a.m. last night answering all the broker emails I've had over the last week, making that happen. So that's where the painfulness is coming. Does direct
Gotcha.
mail work? I have all the absentee owners that have owned for more than 15 years that have no debt on their places, good seller financing candidates. Does it work, or is it a loss of money to send out postcards on
Mailers
it?
mailers work fine.
Okay.
It's not something that I've employed because I haven't had to.
Okay.
That's my main thing. My friend Jesse Lee in out of Renton, Washington, and his partner Steven, that is all they do. They do thousands and thousands and thousands and thousands of mailers. He used to actually hire my lender's kids to write all of his handwritten letters for him. He recently
Okay.
got a handwriting machine that does
Ah,
very
cool.
realistic. It's pretty cool. He's been amazingly successful. The answer is yes, it absolutely works. Um, it's a different strategy. It's higher volume. There's a marketing cost to it, but it's a relatively inexpensive way. The only rule with mailers, small batch is bad data. Like thousands of mailers is kind of the sample sizes that you're usually looking at. Like
Okay.
if you're gonna do it, go all the way, do it in bulk, and do it more than once. Like it is
Yeah.
not a like, oh, let's see if it works over like 200 letters. That's basically doing nothing. It is a mass marketing strategy, and people who do it love doing it. Like if you get it dialed in, can be absolutely amazing.
I've been using chat to create some creative postcards because the system I found has just terrible no appeal postcards. As a regular realtor, the goal with postcards was always slow them down for the 10 seconds so they read the back. So the face of it is dynamic, pulls their interest, and then they flip it over. That's your shot for them, at least thinking about it. It just otherwise it just goes in the trash.
Yeah.
It's a
Well,
boring
and
face.
there's certain stuff like if I happen to get a letter and someone was like, "Hey, I'm looking at boutique hotels. I would love to submit a $4.5 million offer on your hotel." I was like, "Accept. I'm calling them right now." If you hit the
Okay.
right person at the right time,
Yeah.
you do get calls back on those. It's just most people are going to throw it away, so you have to factor for like, okay, this is going to be like less than 1% of people are probably going to do anything here. So I have to do, large batches, but large batches, if that generates 10 good leads, that's a ton of
Yeah.
good leads. So
Yeah. Absolutely.
that's the way to look at those. They do work.
Then the last thing for the day, there's a near the beach motel conversion, vacant now motel. Was that harder to do than a regular lease up? Would you scale that as a harder conversion than the Fresno fixing all that retail, or
Yes.
is it?
Vacant
Okay.
vacant is hard. It's all speculative. It's very similar to development. Even my hotel conversion, I'm getting higher rents than they used to get, but I like when I bought it, that was at about 50% occupancy. And so they'd at least proven here are the leases that we're getting. There's a significant income stream. I have a good starting point where I'm like, I understand where the deal's at. There's a way to get it here. I have a plan for renovating the building. When it's just a vacant building, it's all speculative, which intimidates me quite a bit on deals unless I'm very, very established in that market. And I'm like, I have the team, I have the people, I have the list. I know I have the demand. I can definitely fill this. Otherwise, I'm just looking at it is impossible to cash flow zero revenue.
Hmm. And did you make them all studios, or did you have enough space to frame out a
Uh,
bedroom?
there's a few one beds that were actually originally built into it.
Okay.
And a couple of them have full kitchens. So I had some units that had full kitchens, one bedroom. Most of them are studios with kitchenettes.
Okay. All right. Cool. Thank you.
Yeah, absolutely. Charlie,
Um, so reminder Thursday Zoom call that you were
Yes.
gonna blast out for me.
Yes. Okay, perfect. I will get that. We will blast that out today then. I'll post that on the school.
Okay. Second thing, I'm actually going to that property starting Sunday night, Monday morning to turn the one that's vacant into an Airbnb
Mhm.
because it actually looks like the market will do pretty well with that.
Okay.
And so yeah, so next Monday I might not actually be on the call.
There we
I'm
go.
trying to
Is
remember. I
the
had another question, but I can't remember what it is now because my brain is scatterbrained right now.
did we officially keep the same Zoom link, or do we have a different custom Zoom link?
I sent you a new email. I don't know if it was a new one or not, but I'll verify that it should be. Let me double check. I don't know if I have a. I
Perfect.
don't know if it was the same one or not.
I will find it. I will post that immediately after this, and I will share it on my story. If you
Okay.
have a good, do you have a good cover photo for it as well? If I have a good
Um.
picture,
Yeah.
that
Yeah. I've got
helps.
a good cover photo. I'll get you a photo.
Perfect. That will help me. I'll
I'll get
post
you
it
a
on my
photo and the Zoom
Instagram.
link in like 5 minutes.
Perfect. I will get it posted in like 10 minutes.
All right, that works. That basically, I think that was all I had. I just wanted to to remind on that and say, yep, that's if you don't see me Monday, that's what I'm doing.
Oh, that's so exciting. That's so exciting. You're gonna have a blast.
Oh no, I've set up Airbnbs before. I actually just finished turning one from an Airbnb back into a long-term rental in one of our single families in Tucson. So it's been a busy week, and it's going to be a busy another week, and it's going to be.
Oh,
But
very,
that's where we're at.
very fun.
All right, thanks.
Absolutely. All right. Well, guys, fun call today. I will Thursday's call. I'll select a few things that I'll also post for a couple options for things for us to go over the following week. I plan to do another one of our math deep dives. It's been a second since we've done them. Since we had a small wave of newer people too, I always want to make sure that I do the deep dive into all of our math terms so we understand which market cap rate, deal cap rate, why they're different, how they interact. Loan factor rate's the one that everyone gets confused on, and I get it. While it's simple algebra, it takes a second to wrap your head around because it only comes into play in creative finance. Basically, no one else teaches it, but it's very, very simple. We'll go through things like DSCR, what the bank's looking for, and the different levers you can pull to bring these things up and down. So basically, everything that's in the analytics section of the calculator, we're going to go over the how and why of how they work. I'm not doing that this week. I'm planning on doing that next week, but I just wanted to give everyone a heads up. That tends to be the one that the most people want to attend. So if you have any ambiguity on any of the math, we're going to deep dive all of it and go through how they work, why they work. That should be a good one. This week, I'll come up with 3 topics and I'll post in the group. You guys can vote. The highest voted one will be the goer. I will see you guys then. If anyone else needs anything else, shoot me a text. My number is still the Zoom code, so I will see you guys there.
Thanks.
Thank you.